that, let's move on and get you our first management on the show as well. Like we've been pointing out, we're in the thick of the earnings season, and Laurus Labs is the first one that we're looking at today. The stock is down around 7%. Now, this in spite of the fact that sequentially there has been a recovery. Remember, Q1 was quite terrible for the company, but if you look at it on a year-over-year basis, there's still, a long way to go. So the revenue is down 22% versus last year. The margins, profits, there's been a contraction across the board. So some of those numbers will be up on your screen. But we're now joined by Satyanarayana Chava, founder and CEO of Laurus Labs. Like we were pointing out, Mr. Chava, the company has seen a recovery in the revenue and margins, at least sequentially. There was quite a disappointment that had come through after Q1. There's a little bit of a recovery now. So tell us, how should we read this? Is this some kind of normalization on the business in segments such as API, the fixed dose formulations? Is there any kind of normalization that you're seeing now?
A lot of growth we have seen in APIs, formulations, as well as our oncology API sales was remarkable. We had a very good track. And Bio also did very well when compared to the Q2 FY23 to Q2 FY20. The only one division, which is the one we are very bullish, but we need to have patience on the CDMO division. CDMO division has recorded less sales when compared to the corresponding quarter last year because of execution of commercial orders at the time.
Okay, need to have patience on the CDMO business. Sir, talking about the margins, while there is a Q-on-Q recovery, margins are still at a multi-quarter low. When do you think you will be able to get back to levels of 20% on the margin line? Any guidance on the exit run rate for revenues and margins?
One where we are very concerned, the market is looking at EBITDA margins. We are very concerned about gross margins. The healthiness of business is determined by the gross margins. And if we have higher sales, our all numbers will fall in line. But our focus is to maintain our gross margins. As you have seen, our gross margins improved from Q1 to Q2. The confidence what we had in our H2 will definitely demonstrate good numbers. Both gross margin will definitely remain similar, but we expect higher sales in the second half, so the EBITDA numbers percentage should improve significantly.
Okay, so can you give a sense of the exit run rate? What will that be for revenues?
We are very confident that H2 will be definitely much better than H1, both top line as well as EBITDA numbers. See, if you look at, we have significant depreciation because of our capex, and our manpower cost, operating costs are higher because most of our units are not producing commercial quantities. Once that happens, the negative leverage will be turning positively, then all numbers will be significantly better. Yeah.
All right, it's good to hear that you think the second half of the year will be better than what we've seen in, in the first half. But let's get into some of the individual segments now. How much do you think animal health and the CDMO segment will contribute in FY25? And does the business typically have lower margins than the current CDMO business?
Reiterated multiple times, our CDMO business well diversified, but margin profile broadly remains same, whether we do crop science or whether we do animal health. And we are not compromising on our healthy margin profile in CDMO, but just to diversification sake. So our animal health business also is comparable to the other human health CDMO.
Okay. Can you detail your antiretroviral business recovery, and what can we expect or anticipate going ahead?
Our antiretroviral, both APIs and formulations, in the coming quarters will reach its full potential. And we don't want to go beyond a certain number. That means then we have to resort to unhealthy competition, which we don't want to do that. So we expect our both ARV, APIs and formulation business will stabilize around 2,500. We take our give or take 100 crores here and there, but that is a number where we expect we will maintain the ARV business 2,500 crores around that number, both APIs and formulation put together.
Okay, all right, got that. So moving away from results for a bit, the big development is that your associate company, ImmunoAct, it has, I believe, received approval from the Indian regulator for the CAR-T therapy. Is Laurus going to help that company scale up this business? And would you be looking to hike your stake in it?
We don't have any plans to increase our stake because they are well funded. And fortunately, they also got approval. And we expect they will do commercial launch in the next few months. Then they will have a positive cash flows. So they're well funded. As you're aware, we did Series A, Series B funding to them. And we're helping them to scale up. And they have taken land in the industrial area to build their own facility. With that, they will be able to offer therapy to close to 3,000 patients by middle of 2025.
And would you eventually look to hike stake or buy them out?
No, we have no plans right now.
No plans right now. Okay. Mr. Chava, we'll leave the conversation here for now. Thank you very much for joining in. That's Laurus Laboratories. The stock is down 7.5%, 8% now in trade. This is the fifth consecutive quarter where earnings have missed expectations. The company is guiding for a pickup in H2. They're saying H2 will be better than H1, but the street is not very convinced about the extent of the recovery. And right now, at least, brokerages like Jefferies have lowered the EPS estimates by more than 30% for FY24. So that's a big cut seen in earnings estimates. We'll get into a break on that.